Stock market investing is a long-term process that could help you manage your finances. Investing in the stock market can seem daunting, especially when you are just starting, as it may appear too complex or risky. A careful understanding can help you get started. Among the two top reasons to invest in the stock market are the possibility of getting higher returns to your investment and to develop financial discipline. For instance, when compared with basic saving instruments such as fixed deposits, investing in stocks has resulted in a higher rate of return in the last decade. Periodic investments inculcate a habit of financial discipline, encouraging you to save money and invest it carefully. Here's a brief guide to help you through the process of stock market investing. What is the stock market? In simple terms, a stock market is a marketplace where financial instruments are traded. These can be stocks, bonds, commodities, among others. The two primary stock markets in India are the National Stock Exchange (NSE) and the Bombay Stock Exchange (BSE). The NSE is by far the largest, with over 90% of cash trades. There are also other exchanges for commodities like the Multi Commodity Exchange (MCX) and the Indian Energy Exchange (IEX) for power trading and so on. All activities as well as participants of the stock markets, including day-to-day trades, instruments being traded, exchanges that enable the financial instruments to be traded, are regulated by the Securities and Exchange Board of India, SEBI. Apart from listing companies, these exchanges also manage indices. An index is a basket of stocks that represents a theme, be it size or industry. It also allows investors a common gauge on the trend in the stock market. The most common indices in India are the Nifty and Sensex. Nifty is a basket of top 50 stocks by market capitalization listed on the NSE. The Sensex is a similar index of 30 companies listed on the BSE. The stock market indices are commonly used to benchmark the performance of fund managers and other stocks. For instance, if a mutual fund that benchmarks its performance to the Nifty did 15% returns this year and the Nifty did 20%, the mutual fund actually underperformed its benchmark. This means you would have been better off just buying those 50 Nifty stocks instead of relying on the fund manager's expertise. How to invest in the share market? You cannot buy or sell directly on the stock market. For this, you have to go through brokers who are authorized to trade on the market or stock brokerage companies that allow you to trade using their platform. The process is simple. To begin investing, you have to open a trading account with a broker or a stock brokerage platform. A trading account is where you actually trade or place buy or sell orders. The broker or the stock brokerage platform opens a Demat account for you. A Demat account holds the financial securities in your name. These two accounts are then linked to your bank account. To open a trading and Demat account, you need to provide Know Your Customer (KYC) documentation that includes verification via government-authorized identity cards such as the PAN card or your Aadhaar. Most brokers and brokerage platforms now have an online KYC process that allows you to open an account in a couple of days by submitting your verification details digitally. Once open, you can trade with your broker or brokerage company online via a portal or offline via phone calls. What does it cost to invest in the share market? There are a few types of charges that you will usually pay. Transaction costs. All brokers are paid a brokerage, which is a fee they take to facilitate a trade for you. With the advent of discount brokers, these costs are quickly shrinking. Apart from brokerage, they also collect taxes and dues paid to the government on each transaction, such as the Securities Transaction Tax, STT, SEBI charges, Goods and Services Tax, GST, among others. Demat charges. While your broker or brokerage platform opens your Demat account for you, they do not operate it. Demat accounts are operated by central securities depositories such as NSDL or CDSL, under the government's jurisdiction to safeguard your interest. You are expected to pay nominal annual charges, typically collected by your broker or the brokerage platform, to maintain your account. These charges range anywhere between 100 Indian rupees to 750 Indian rupees. Taxes. You pay a percentage of your profit from your investments to the government as taxes. For stocks, if you hold them for longer than a year, you pay long-term capital gains tax. which is 10%, and if you hold for less than a year, you pay short-term capital gains tax, which is 15%. Both of these tax rates change based on cess or surcharge charged by the government. Thanks for watching Indian Stock Hunter. Please subscribe and stay tuned for more valuable contents.